Welcome to the WealthWise Show, where financial success meets informed decisions. I'm your host, the Wise Investor, and I'm here to guide you through the fascinating world of finance and help you to make wise choices. Join us as we unravel the secrets of smart investing and effective money management strategies in the different realms of financial education. Remember, the information provided on this podcast is for informational purposes only and educational purposes only. Always consult a financial professional before making any major financial decisions. Now let's start the show. Alrighty, guys. Welcome to another episode of the WealthWise Show. I appreciate you listening. Just get a little housekeeping out of the way because this is going to be a pretty large episode. Please, guys, don't use this podcast and this episode or any episode as personal finance advice, investment advice. Don't get enticed with some of the companies I say, or indexes, or mutual funds, or anything like that. Please do your own due diligence and talk to a professional financial advisor, a fiduciary, someone with their Series 65, and get advice from them. Don't use this podcast as such. This is for educational purposes only and informational purposes. So please use it as such. With that being said, today's episode is actually going to be broken up into a few episodes. I know last week I said that I'm going to start doing larger episodes and just breaking them up, and that's what I'm going to try it out. You know, we're 30 some episodes in, so why not see if it works and sticks? Maybe it'll make sense for me because, it'll be great. I don't have to, put so much production since I'm doing it all myself. But the one topic can allow me to really hone in on it to make it a quality episode. And if I'm doing it all in like one take, essentially one long format, but breaking it up for you guys over a certain period of time, then I think I can, really hone in and make it quality wise. So we'll see how it works. If you don't like it, just let me know. If you do like it, let me know. So with that being said, I wanted to talk about the S&P 500, the index, and one of the things a lot of people ask, that I get asked at least, what is it? Why is it so important? So for starters, the S&P 500 is an index of 500 U.S. companies. So they are the leading companies, the best companies. And, the strategy that the S&P have is, if the companies are doing great, they're in there. If they're not doing great, they're out of there. And, they are technically 503, but did I say 503? 503. I just did it again. 503. And not really 500, but, it's a catchy, it's better than the S&P 503. It was launched in 1957. Yep. It was launched in 1957. And the S&P actually stands for Standard & Poor's. So Standard & Poor's was launched in the index was launched in 1957 by the credit rating agency Standard & Poor's. Standard & Poor's is a credit rating agency. So typically they rate a lot of times credit of companies. So if a company, let's say, issues some debt or some bonds, when you might hear, if you ever watch The Big Short or something like that, and you ever heard them say AAA rated and double B's and all that stuff, those are the ratings that these credit rating agencies give to these companies to determine their credit worthiness. So at Standard & Poor's was one of the original credit rating agencies, and they launched the S&P 500 index. It makes sense because they knew the insides and outs of these corporations. They knew the finances, because they, credit rating, they look at your credit history. They look at all sorts of stuff like, you know, Experian, TransUnion, what's the other one? Well, you know, the credit bureaus. So think of the credit bureaus as, or they're the credit bureaus, but Standard & Poor's as a credit bureau, essentially. Yeah. You know, so they determine, you know, the credit rating for a lot of these companies. So it makes sense that they would do a index of the best companies because they know who has the best credit and their insights and their workings and, you know, things like that. They are privy to that stuff. Technically, we all are, but that's their job, you know. You know, you can go look at all of the 500 best companies and look at their 10Qs and 10Ks and, you know, their earnings and blah, 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 and all sorts of stuff. But this is what they eat, sleep, and breathe. So it makes sense, you know, why they're, you know, pretty great. So, yeah. So at the S&P 500 of the best companies. It was launched by Standard & Poor's in 1957. And there's actually different indexes that Standard & Poor's have. You know, typically the S&P 500 is market cap weighted. So what is market cap weighted? Well, first, what is market cap? So a market cap is basically the capitalization of a company, how much, you know, the value of the company, essentially. So when you're thinking about, let's say, I'm trying to think of like Apple. Like when they say Apple is $1 trillion company, Apple may not have $1 trillion in its bank account, but the value of the company is $1 trillion. You know what I'm saying? So when you're thinking about market cap, market capitalization. Market cap is something, I'm just going to say market cap because it's easier. That's what I'm used to. So market cap is short for market capitalization. So it basically refers to how much a company is worth determined by the stock market. You know, it's a total value or market value of all outstanding shares, the cost of it. So when you're thinking of, like say Apple, it might not have $1 trillion in its bank account, but it is valued at that, because of the shares and things like that. So back to, market capitalization weighted indexes, which is the S&P. So basically, whoever is valued at the most, that's the weight. And when they say weight, it's basically saying how much they're invested into it. So let's say you have a 100%. You have a pie of 100%, and you split that pie equally, 500, divided by 500. You know, now some companies might be better than other companies, but because, you know, typically the higher the market cap, the better the company is doing because people are investing in it. But like I was saying, if you have 500 individual slices of different companies and they're all equal, the thing is, the companies that are doing bad can bring down the whole thing. So, you know, even though the S&P Standard & Poor's do have an equal weighted index, but we're not talking about that. But so typically you want to go with market cap weighted because typically the company with the higher market cap is going to be a better company. So why give more money to the lower market cap companies who are, you know, they're good, but they're just not as good as their counterparts, when, you know, I can put money into this and give them a little bit less. And then once they start getting great and getting better, then I can, and their market cap starts to increase, then I can start giving them more money. I feel more comfortable now. So that's essentially with a weighted market cap weighted index, what it does. So you know, determining the weight of each component of the S&P 500, you know, adds up the total market cap for the index, essentially. And so the S&P 500 is one of the big indexes. So you have the S&P 500, you have the NASDAQ, you have the Dow. And you also have the Russell 2000. Actually, by the way, there's tons of indexes. But we're talking about the big ones that typically everyone's going to know. So you're going to have the S&P 500, the Dow, the NASDAQ, and then the Russell 2000. And with the number behind the name of the index typically lets you know how many companies are in that index. So you hear like the Dow 30, that's 30 companies. The index or the NASDAQ 100, that's 100 companies. The Russell 2000, that's 2,000 companies. And they all have different strategies, and they all are different, really. The Dow is more industrial. The NASDAQ is more leaning towards tech. Not the Dow. Yeah, the NASDAQ is leaning towards tech. The Dow is industrial. The Russell is more, smaller companies that, can't really make it into the S&P 500, but, they're on the index. And then you got the S&P 500, which is probably, I would say, is one of the smartest strategies, because it has a mix of it all. It has a mix of industrials, has a mix of industrials, tech. They have different sectors. So it's just a index that's full of the best. Doesn't matter if you're more tech heavy. Doesn't matter if you're more industrial heavy. You're just the best. So the way the index, pretty much constructed, like I said, is calculated by market cap. And then, like I said, some of the competitors is the Dow Jones, and then you got the NASDAQ. But, honestly, never mind. I'm not going to give my opinions on those things. But the S&P is really good. And one of the largest holdings in the S&P is Apple. Typically a lot of tech stocks, honestly, but Apple is one of the largest holdings for the index. So like I said, that's the basics of the S&P 500, and I really want to go a little more deeper into now not just the S&P 500, but some of the smaller sectors of the S&P 500. So like I was saying, the S&P 500 does have different indexes. So some of the other indexes include the S&P mid cap 400, the S&P small cap 600. And the thing about these two other indexes is now capitalizing on pretty much the stock market as a whole. I mean, and I say that because, typically the S&P 500 is market cap weighted, but is usually going to go with higher market caps. So let's say you have a smaller company who, like a startup, that's really good, and the market cap just not there yet, but they're well on their way. Now with the S&P 600, it can do that. The S&P 600 with the small cap can do that. And I know I didn't mention, I'm pretty sure I didn't mention, sorry for the little car I coughed. What is small cap, mid cap, large cap? So, I know I'm giving a lot of information in this episode, but don't worry, it's worth it. So let's start with small cap. We're going to take a pause on the S&P stuff for a second to go over, what is small cap? So basically, remember when I was talking about market capitalization determines, basically the market value of companies and things like that. Well, small cap is typically companies that are valued around 250 million to 2 billion. And I know a lot of you might just said, that's not small. That's a lot of money. True. But if you're on the index, you're already IPO'd and things like that, you're gonna, you're not gonna be a mom and pop shop essentially. So yes, that's what small cap is. Companies who are valued at 250 million to 2 billion. Now, what are mid caps? what is what are mid caps? What is mid cap? So mid caps are essentially are companies that, oops, I'll just click something, didn't mean to do that. Mid caps are essentially companies between 2 and 10 billion, so they're not large, they're not small, they're mid, but not mid in the sense of the company, it's just mid in the sense of how much they are. And large caps are big cap companies, are companies that are valued more than $10 billion. And I know a lot of you might say, well, that's a lot of money. It is. But remember I just said Apple is a $1 trillion company. So a lot of these companies have a lot of value. So back to the Standard & Poor's 600. So basically, just like the S&P 500, the Standard & Poor's 600, it's going to be made up of, companies that are small cap, essentially. And even though they are, small cap, they might be decent companies. They're just growing, making their way up, and all that good stuff. And same thing with mid cap. Same thing with, the S&P mid cap 400, same thing. So those are the other indices that, is made up of Standard & Poor's, family of indices. And there's tons other. There are tons other indices by Standard & Poor's, but I would say those are probably at their flagship, with the actual flagship being the S&P 500. And so compared to the Dow Jones, the S&P 500, it's decent. I would say better. But like I said in my intro, these are my personal opinions. Just me personally, this is how I feel. And the decisions that I made for myself, I'm trying to help you to learn how to make those decisions with the help of your personal guidance or your financial advisor, thing like that. But yeah, the S&P 500 is really good. And even though, because I would say one of the reasons why they're really good too is because the S&P 500 is so accessible. So there are index ETFs. So I'm pretty sure there's a episode where I explain ETFs and what they are. And I'm pretty sure I explained that ETFs are, exchange traded funds. So funds that you give them money and they invest in certain things. So there are index ETFs that, they track other indexes. So there are index ETFs like the SPY, that tracks the S&P 500. So when the S&P 500 makes a move and, invest in a certain company or something like that, these other indexes are ETFs and companies, they do the same. So they can stay on track with the S&P 500. So you can't readily, I won't say readily, you cannot directly invest into the actual index. Like, you can't go and buy index shares. But you can buy ETFs that track those indexes, and they pretty much move at the same pace. So, yeah, that's I would say not a whole lot, but enough when it comes down to the S&P 500. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. any insurance, consulting, and education services offered through the WealthWise Show. The WealthWise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.